A new case every real estate investor must know. Hey everyone, Adam Bergman here, tax attorney and founder of IRA Financial, and welcome to another episode of Adam Talks. On today's Adam Talks, a new case that was issued July 11th, 2024 by the tax court, and it's called Timothy L. Ferratis and Jessica L. Moore versus the IRS. And I wanted to highlight today's case because it's an important case that describes the loss limitation passive activity rules for real estate investors. So not all real estate investors understand that you can't just deduct every real estate deduction and offset your income with real estate losses. Unfortunately, it just doesn't work that way. Why? Because there's something called passive activity losses under Section 469 of the code and under Section 465 at-risk rules. Okay, and that basically limits people from taking passive sources of income and offsetting that against their active income. And those rules were put in the code in 1986, stop all the real estate tax shelters, right? You probably heard about it in the 80s. People were building huge skyscrapers in Houston and Texas, Dallas, and various cities across the country only to generate losses, right? Because all those losses from the depreciation and the expenses were used to offset active income. So the IRS said, you can't do that anymore. It's a tax shelter and we're not going to let you do this. So they included something called passive activity losses under Section 469 and then the at-risk rules. So I want to go through this case because it's not a very long and difficult case. The facts are pretty simple. I think we all can relate to it. And it's helpful because every real estate investor should understand how the loss limitation rules work. So here are the facts. In 2020, Ms. Moore, she earned about $82,000 and worked full-time 40 hours a week. And Mr. Ferratis, he also worked 40 hours a week, earned about $79,000. And during 2018, they received building permits to build a new building. Okay, it was called the Carriage House. It was a residence, like a little apartment building. He was still working full time in 2020, Mr. Ferratis, and he hired persons to do the work. Obviously, he didn't build the building himself. Ms. Moore did not work on the construction or renting out the Carriage House. After they built the Carriage House, Mr. Ferratis hired a small rental management company and October 1st, 2020, to manage the Carriage House rental and do all the servicing relating to the property. They filed their tax returns, and on June 26, 2023, the IRS issued the taxpayers a notice of deficiency, disallowing $22,376 of rental real estate loss deductions. Okay, so what happened here? Well, the petitioners, Ferratis and Moore, built this building and had all kinds of losses relating to the construction of the building, and then generated $22,376 of rental real estate losses to offset their active income. So what's the law? The law under Section 162 and 212 generally allows a taxpayer to deduct ordinary and necessary expenses paid or incurred in carrying on a trade or business or for the production of income. But obviously a taxpayer must maintain adequate records. So in the case of an individual, as I mentioned, Section 469 disallows any current deduction for passive activity losses. And the effect is essentially to limit passive losses to offset active income. And generally a passive activity is any trade or business in which the taxpayer does not materially participate. Rental activity is passive unless the taxpayer qualifies as a real estate professional. Now, this is the most important part of the case, and this is something a lot of real estate investors don't understand. So, by definition, passive activity is any trade or business in which the taxpayer does not materially participate. And for rental activity specifically, in order to not be deemed passive, you have to be treated as a real estate professional. Okay? And if you meet the definition of a real estate professional, then Section 469, the passive activity loss rules do not apply, and therefore you're able to use those losses to offset active income. Section 469C7B provides two tests that a taxpayer must satisfy to be deemed a real estate professional and have those passive losses not be treated as passive. Number one, more than half of the personal services performed in the trade or business by the taxpayer during the taxable year are performed in real property trades or businesses in which the taxpayer materially participates. So again, more than 50% of the personal services performed in the trade or business by the taxpayer during the tax year are performed in real property trades, and the taxpayer performed more than 750 hours of services during the taxable year. Okay, so what happened? So Mr. Faradas, based off the facts at hand, worked approximately 40 hours as a full-time employee, and Mr. Faradas worked as a full-time employee approximately 2,000 hours during the year in question. Faradas testified that he spent approximately 2,500 hours building the carriage house in 2020. He testified that he constructed the carriage house after work and on the weekends, as well as during vacation. And the court said they do believe that Faradas spent a lot of time constructing the house, but it did not find it credible that Faradas spent more hours on the house than his full-time job. And the court found it's implausible that Faradas would work 40 hours a week as a full-time person at a job and at the same time work an additional 40 plus hours building the home, right? It's almost 80, 90 hours a week. And they basically said, we're not required to accept this. You have the onus of proof as the taxpayer, and we don't believe you. And so basically, Mr. Faradas said he performed personal services with respect to the real estate activity business, and he cannot prove how much he spent, right? He can't say he spent more than half of his total personal services performed in trades and businesses on his rental real estate, okay? And they basically said, because you can't prove that, you failed the first test, which is that 50% or more of your personal services performed in the trade or business were performed for real property activities. And he didn't have the record to prove it. I guess obviously he didn't clock in or clock out. He didn't have any proof. And since the burden of proof is on the taxpayer, he failed the first test, and therefore the tax court did not need to go to the second part, the 750-hour part. So this is an important case. Number one, it explains the rules very clearly what 469 is. The fact is, you need to satisfy those two requirements to be deemed a real estate professional, so you can have your losses not deemed passive and be able to offset active income, which is very important because that reduces your taxable income. Now, if you only have passive income, you may not care as much, but most people want to use their passive activity losses to offset active income. So that's number one, understanding how those rules work. Number two, it's an interesting case because it shows again that the onus is on you as the taxpayer. So it's not good enough to just say, well, yeah, I worked 2,500 hours. I promise, I swear under oath. No, you need proof. So what kind of proof? Witnesses, right? Somewhere that you're clocking in and clocking out on the premise, showing your phone, GPS, that your phone was there for a certain amount of hours. Witnesses are the best, obviously, or sign in, sign out with a witness attesting that you were there for that period of time during the day. That's obviously the best. But it shows that the IRS and the tax court, they're just not going to believe what you tell them. Okay. And it's important because a lot of people tell me, Adam, I get why you are in the IRA business. I understand as a tax lawyer, you appreciate the tax efficiency of using a retirement account and make an investment, but I don't particularly agree with you on real estate because one of the advantages of real estate is you get to offset your income with the deductions, depreciation, expenses, and it's a very valuable tax deduction source. And like, yeah, agreed. But do you understand passive activity loss rules? Because a lot of real estate investors are doing it passively, right? They got a full-time job, just like the case at hand, Mr. Faradas. He had a full-time job, worked 40 hours a week, which most of us do. And he couldn't prove to the tax court that he was deemed a real estate professional and spent more than half of his time on these real estate business activities. And again, I think most of us will satisfy this fact pattern, right? We have full-time jobs, and we also do some real estate on the side. I know I did, and I do, but I own it in a real estate. I own my real estate in an IRA, so I'm not as worried as receiving losses. I'm more focused on offsetting gains and rental income from taxation. But the Faradas case is interesting again because you can now see what the tax court and the IRS is looking at, and you have to really understand these two requirements under 469 to be deemed a real estate professional. More than 50% of the personal services performed in the business by the taxpayer are performed in real property. And he couldn't prove that he spent more than 50% of all the hours at stake doing real estate. And he didn't keep good enough records. He probably had better record keeping procedures. He may have been able to succeed and prove to the court that he actually did spend this time, and then he would just need to show the 750 hours, and he would be deemed a real estate professional and would be able to satisfy the rules and be treated as a real estate professional, and the losses would not be limited by the passive activity losses in Section 465, the at-risk limitation. So that's it. I think it's an important case that real estate investors, whether you're active or passive, just understand it may not apply to you. It's something you may want to talk to your accountant about. Just kind of understand passive activity losses, how they work, how they apply. And again, another reason why I believe using an IRA is super advantageous, because in a lot of cases, folks think that their passive investment is going to allow the deductions and losses to flow through and offset active income. And people aren't aware of the passive activity losses. And assuming your accountant will tell you, hey, unfortunately, you can't use these losses. And then what you're doing is now you lost the benefit of the losses because of the passive activity loss rules, and you're going to have to pay ordinary income tax on rental income. You may get capital gains, but you'll have to get depreciation recapture on a sale for all the depreciation. So it's not such a win for, hey, I get my tax deductions, and it's better to own it in a personal account outside of my retirement account versus inside my retirement account. It's not as easy to argue that case now, and I think the Faradas case is a good example of that. So thank you for listening. If you're watching on YouTube, hopefully you like our new format. I actually like this a lot better. It's more fun. You don't get to see me in a big screen. It's in a small box, and it's better. You don't want to stare at my face for that long. I think it's just easy. I can share stuff on a screen. It's more fun. So that's it for today's podcast. Hope you enjoyed it. Have a great day. Don't forget to subscribe, and I'll see everyone again on the next podcast. Thanks.